Hey everyone! Today, we're diving deep into the latest in the financial world. There's plenty to cover, so let's get started. August 5th began with a bang but ended on a quieter note. The markets took a sharp dive early in the week, but by the weekend, things had calmed down considerably. The S&P 500 dropped over 4% on Monday, yet by week's end, it had only declined by 0.04%. Quite the turnaround, right? One of the big stories was the Volatility Index, or VIX. It soared to 65.73 on Monday morning, which signaled panic in the markets. But by the end of the day, it had plunged 41% to 38.57, which was the largest peak-to-close drop in history. Even after this, the VIX was still up 136% from just 3 days earlier, marking one of the biggest short-term spikes we've ever seen. It's known for mean reversion, and true to form, it dropped another 47% over the next 4 days, which was its largest 4-day decline ever. By the end of the week, the VIX settled at 20.37, which was 13% lower than its previous week's close. What a roller coaster! Sentiment-wise, the recent 10% pullback in the S&P 500 rattled even the most bullish investors. Just 2 weeks ago, the Investors' Intelligence Index showed 64.2% bulls, which was the highest level since 2020. Last week, however, the percentage of bulls dropped to 46.9%, which is much closer to historical averages. That's a 17% drop in just 2 weeks, which is the biggest sentiment swing since the October 1987 crash. It's amazing how quickly the market mood can shift, isn't it? Warren Buffett has been in the spotlight lately, with speculation that he might be turning bearish. Berkshire Hathaway's latest earnings report revealed a cash pile of $277 billion in Q2, which was up by a massive $88 billion, mostly from stock sales, including nearly half of their Apple holdings. Berkshire's cash now accounts for 25% of its assets, which is the highest percentage since 2004, well above their historical average of 14%. So why is Buffett raising so much cash and cutting back on Apple? One reason could be to lock in gains before tax rates rise. Buffett has mentioned that higher taxes are likely due to current fiscal policies. Berkshire is currently paying a 21% tax rate, but in the past, it's been as high as 52%. But taxes might not be the whole story. As a value investor, Buffett might be eyeing Apple's current valuation. Since he first bought in 2016, Apple's P/E ratio has tripled, and its price-to-sales ratio has hit a company high of 9 times. Apple's share price has soared 859% in the past decade, while its fundamentals haven't kept pace. This could be a signal for a value investor like Buffett to trim his position. Is he bearish? Hard to say, but he's certainly less bullish than before, perhaps preparing to be greedy when others become fearful. In the bond market, specifically high-yield bonds, there's been some notable movement. A few weeks ago, U.S. high-yield credit spreads were near their tightest level since 2007, which was at 302 basis points. However, during the S&P 500's recent 10% correction, spreads widened by 91 basis points, reaching 393 basis points, which is the highest level since November 2023. Does this suggest bond investors are pricing in a recession? Not yet. In the last 3 U.S. recessions, credit spreads moved over 1,000 basis points at some point. Today, we're not even close to that, and credit default expectations remain low. It's an intriguing situation, especially given a recent poll on X. 29% of respondents believe we're already in a recession, 33% expect one within the next 6 months, and 38% think the expansion will continue. Interesting times indeed. What could push the economy into a recession? One big factor could be consumer weakness. Consumers account for about 70% of GDP, and many have been relying on credit to stay afloat. Credit card debt hit a record $1.14 trillion in Q2, which was up 10.8% from last year. But rising delinquencies are a concern. 11% of U.S. credit card balances are now 90-plus days delinquent, which is the highest since 2012. If this trend continues, it could spell trouble for the broader economy. Trouble is also brewing in the commercial real estate market. Higher interest rates and the shift to hybrid work have hit office buildings and urban retail hard. In Q2, U.S. commercial property foreclosures reached $20.55 billion, which was up 13% from Q1 and the highest since 2015. According to the Wall Street Journal, State Farm Life Insurance recently sold an office building near the White House for $17.6 million, which was over 70% below what the owner paid in 2010. The delinquency rate on a commercial mortgage-backed securities for office properties has jumped from under 2% in 2022 to over 8% today, which is the highest since 2013. The commercial real estate market is definitely under pressure. As for the Fed, a September rate cut seems likely. The question is whether it'll be 25 or 50 basis points, which would lower the rate to 4.75% to 5%. The market is split on that. Here's what's strengthening the case for a cut. Gas prices are down 10% year over year to $3.45 per gallon, which is the national average, and this could push down headline CPI for August. Market-based inflation expectations dropped to 1.89% last week, which is the lowest since December 2020. According to the latest NY Fed survey, U.S. consumers expect inflation to average 2.33% per year over the next 3 years, which is the lowest level on record since the survey began in June 2013. Before we wrap up, here are a few stats that caught my eye. Apple has bought back $646 billion in stock over the past decade, which is more than the market cap of 491 companies in the S&P 500. The U.S. personal savings rate is at 3.4%, which is the lowest since 2022. The 30-year average is 5.8%. Amazon's AWS revenue over the last 12 months, which is $99 billion, was higher than the revenue of 468 companies in the S&P 500. The semiconductor index closed below its 200-day moving average last week for the first time since November 2023. The 23% drawdown from its July peak was the largest correction for semis since 2022. And that's a wrap for this edition. Keep an eye on these developments as the markets continue to evolve.